Okay, we've had quite a few weeks, couple of weeks of chaos in the markets, and I think it's just a good point right now. We just kind of catch our breath and figure out where we've come from and where we are, and ultimately where we could be going. So we're just going to try and mind map some ideas here. So before we got to February here, what kind of world were we living in? We were living in essentially a crazy low interest rate world. And with low interest rates, people were looking for yield. And when you're in an environment where your interest rates are rock bottom, you're probably going to be looking to increase the amount of risk that you're willing to take. And so you're in an environment essentially where um, dividend yields are greater than bond yields. And what does that do? Basically, when you're getting more dividend, you're yielding more on holding a riskier dividend, a riskier asset than a less riskier asset. You're going to gravitate to the riskier asset. So what's that led to? Is it's led to a lot of money going into stocks, real estate, and even crazier stuff like crypto cryptocurrencies like Bitcoin and all that stuff. What's that done is that investors essentially have had been a lot of firm conviction by investors, and that's essentially created this low volatility environment that we've been living in. And ultimately what's happened also, because of the low volatility, investors are just increasing confidence, and that's been an increase in market sentiment, investor sentiment. And we're seeing things like amount of cash in portfolios has gone down, and the amount of debt margin has increased. So that's where we've been. Now, where are we? What happened? So all of a sudden, what's been happening, but people just really haven't been noticing it, is that interest rates have not been going up, but they've been just sort of like going up a little bit, and all of a sudden, people have just sort of woken up to that. We've had a bit of a wake up call, and all of a sudden, we're in a world now where bond yields are greater than dividend yields. And so a lot of people are asking, why own stocks? Why own stocks? Why own risk? And so what's happened? People are just basically taking off risk. They're just taking out of the risk, and what does that lead to? Leads in a fall in stock prices, leads in a fall in real estate. And guess what? It's no coincidence that cryptocurrencies have been falling down too. So what's happened now is we've gone from a period where investors have been very confident, and now with the big pullback, we're seeing decreased confidence. And when people are uncertain, essentially that's going to create a increase in volatility. So that's kind of where we are. So it really, ultimately, what's different is interest rates. Before they were low, now they're high, and essentially volatility has increased. That's really what's driving this whole argument right now. So that the question is, where's the future? The future is, if this dynamic of this slow, steady increase in interest rates continues, then chances are we're probably going to see more of this stuff happening. But if we get to a point where the central banks want to kind of pause and keep rates kind of low or steady, then the market we might see more of this kind of enthusiasm emerge. So that's kind of where we are right now. It's really all about, the real big change has been the change in interest rates, and it's changed the level of volatility, and it's changed sort of the confidence level and the sentiment level of investors.